So how's it feel to be back in person? And how does it feel to be coming off of the worst year in financial markets in over a decade? Okay, not good. Many of you are probably familiar with the story of the two campers who encounter a big grizzly bear. One of them goes down on his knees and starts praying, and the other one starts lacing up his running shoes. And the one who's praying turns to the one lacing up his shoes and says, "Why are you doing that? You can't outrun the bear." And the camper lacing up his shoes says, "I don't need to outrun the bear, I need to outrun you." Nobody could outrun last year's bear. There was no place to hide last year. S&P down 18%, NASDAQ 33%, the ETF from ARC, probably the best measure of kind of a public measure of venture investing, down 67%, the Bitcoin crash. We'll talk more about SPACs later, but the SPAC index down 18%. The only green here was the global macro index. These are the hedge funds that are betting on trends relating to interest rates and currencies and global macro decisions, and then oil, partly due to the war in Ukraine, but due to supply chain shocks. So there was really nowhere to hide, and it was the year where the tech and innovation world in which we sit learned that macro matters. Now, what was the big driving macro force? It was the end of a 40-year run in declining interest rates. This chart goes back to Paul Volcker attacking interest rates in 1980 when the 10-year bond in the US went to 15%. Again, risk-free rate, 15%. Short-term rates were 18%. And he attacked it and started a 40-year run. If you look at the last 7 years, we thought we'd hit the bottom right before the 2016 election in the US, but then we plumbed new lows on rates during the pandemic in 2020. But look at that chart up to the right. Its discount rates go up when interest rates go up, and the types of businesses whose cash flows are furthest in the future are the ones most affected because those future, far into the future cash flows are discounted back at a higher rate. It's simple, it's unavoidable. Now, why was the Fed going after interest rates? Well, it was because we saw the greatest inflation in the US and in many other economies in 40 years, a tremendous spike driven by various factors, but the two most prominent, were probably the $1.9 trillion stimulus package in early 21, and then the supply chain shocks coming off of the pandemic. So kind of simple economics 101. You drive demand up, you drive supply down, guess what happened? Prices go up. But it's important to realize that there were policy decisions behind these challenges. I mentioned the fiscal blowout. We also had the US Fed in action in 2022 to so-called transitory inflation. It wasn't transitory. The China COVID lockdown, stunning growth in the #2 economy, and also contributing to some of the supply chain shocks. The sudden pullout from Afghanistan, to what extent did that contribute to the invasion in Ukraine? We'll never know, but it probably did. And then the vulnerability in Europe to energy from Russia because of an unbalanced shift to renewables, particularly in Germany. In fact, there was a poll came out a few weeks ago in the US by Gallup. For the first time ever, the #1 problem cited by US citizens in the US was not inflation, not crime, not the economy. It was the government and leadership. Never been the top problem before. Now, maybe we're seeing some improved leadership, and I'll talk more about major decisions into 23. The Fed may be engineering a soft landing. We have record low unemployment in the US now, but within the tech world, we clearly have a jobs recession. We're getting used to seeing these headlines, whether it's the Amazon layoffs being moved up to 18,000, Meta 11,000, Microsoft 10,000. Here in Israel, Jerusalem Post reported 1,100 layoffs in December. Overall, if you see at the bottom of this, we are at the end of an era in the last several years. The great tech expansion has been taking a hammering with this layoff spree, despite unemployment elsewhere being very, very low. Now, I want to put this in historical perspective. I've shown you 5 years of S&P 500 performance. I wish I could run a contest to see who could figure out which years and throw them some OurCrowd swag. But let me show you what years these are. 1979 to 1983. Didn't I just talk about record inflation, record high interest rates? And then think about geopolitically back then, the Iranian Revolution, the hostage crisis, invasion of Afghanistan, the Olympic boycott, the Moscow Olympics, the Reagan defense buildup. It was not a very pleasant time economically or geopolitically, but yet the stock market performed. I'll take those four. Anybody else want to take these 5 years starting this year? I'll take them. What was happening was the reestablishment of fiscal and monetary credibility. That's what markets react to. Let's turn to the macro VC environment. Now, in the US last year, we actually saw a record in terms of venture capital dollars raised, not funds. You see the number of funds dropped, but a record largely on the back of great performance being sold to the institutions that serve as the LPs. We saw deployments dropping sharply, however, quarter by quarter. In Israel, not a record year, but a solid year. I know Shlomo is going to talk a little bit more about that in a few minutes, so I won't dig into detail here. But solid fundraising year, but once again, very sharp drop in deployment into VC. Now, one of the reasons these allocations continue, despite what's going on in the markets, is that venture capital not only has had historically high risk-adjusted returns, but is also non-correlated to large cap equity and only partially correlated to private equity. But we've got some clouds on the horizon. This is a PitchBook measure of what's called a rolling horizon IRR. You see VC had been the highest number, and it's moved down. All three have moved down, VC, private equity, and fixed assets, and they're all negative right now. Again, not that surprising given what's going on in the markets, but a really sharp downturn there. And then another warning cloud is that we still have never seen a recovery of the IPO markets. This is looking at the exit of venture-backed companies. And in the 90s, a company was just as likely to go IPO or more likely to go IPO than to exit through M&A. That shifted in 2000, and that secular change has never reversed. But if you look at that last bar in 2022, it's the smallest green bar in over a decade. So we're seeing a very, very tight IPO window. Now, many people thought, well, we're going to have a new way to exit. We're going to SPAC companies. Well, that bubble has certainly burst. This is the amount raised and the number of SPACs that have gotten done. And this was also a function of zero interest rates. Hedge funds and other investors could put their money away, earn 1.5%, which was a pretty good rate a year or two ago, not be committed to vote for the deal, not be committed to invest in the deal that was brought to them, have total optionality. Well, I think we're familiar with how this has played out, and SPACs have been disappearing. So it is not serving as the new route for exit. So let's look forward to 2023 and talk about the policy decisions, having established how important some mistakes contributed to what we've seen in the last few years. What will be the pace of central bank increases, antitrust actions, very important for the tech economy. If a Facebook's going to be attacked for buying a company that's in a market it's not in, what does that mean for startups who often look to these tech giants as their route for exit? How will the OECD economies address their government deficits, particularly with interest rates going up? And then the free trade momentum that has controlled inflation for decades. We've seen a move in many ways from just-in-time supply chain management to just-in-case in terms of having your resources nearshore or onshore to not be vulnerable to a disruption as occurred in the pandemic or some other geopolitical shift. On the geopolitical side, we're all familiar, whether it's the war in Ukraine, the dynamic, if you will, between China and Taiwan, containment of rogue nations. Here in Israel, we saw the general strike yesterday. What will be the impact of the tech ecosystem of the potential judicial reforms? But deals will get done. The message of the amount of capital that I showed earlier that's been raised is there's a lot of dry powder. And companies on the bottom will need to raise capital. So there will be an intersection where investors and companies can get to yes and can come to terms on a deal. And you'll be hearing a lot about that today and tomorrow, in terms of what it will take for deals to get done. So predictions for next year, we've been seeing a lot of these SAFEs and CLAs. Let's not go into what the acronyms mean. I think the way to think of it is these are ways that companies extend and pretend in terms of their equity. They extend and pretend. Well, I will predict that extend and pretend is about to end. The down round reckonings are coming. They can no longer be delayed. We'll see more use of venture debt. We'll see a lot of structure as companies seek to retain that nominal price, say, I'm still a unicorn, even though I just raised money with really, really ugly terms. And M&A exits will absolutely continue to dominate. It's going to take 100 million of ARR in many cases, that's annual recurring revenue, to be able to go public. This is sometimes now called centaurs as opposed to unicorns. And overall, it's simply a greater focus on cash flow and growth improvement at the expense of revenue growth. Now, there's been a lot, of course. I want to finish on some comments on AI. Obviously, a lot of talk about that recently. ChatGPT may indeed be an IBM PC, Netscape browser, Apple iPhone type of moment, which leads to a whole new step function of growth. The metaphor I prefer, though, is to think about the roaring 1920s, which were driven by electrification permeating the economy, and maybe we'll have a roaring 2020s as AI permeates every industry. But AI is not new. The term goes back to the 50s. A lot of these methodologies have been around. What's finally happened is that the computing and communications infrastructure, processing speed from GPUs, storage, the access to both in the cloud, input devices, output devices, the communication through 5G and soon 6G in this decade, the availability of big data from all kinds of sources, including Internet of Device types of things. This is what has enabled the infrastructure to finally catch up with the methodologies that have been around for a very long time. And if you consider the power of generative AI and think about those campers that I began with, maybe, just maybe, AI will be able to generate far too many campers for any bear to catch. Thank you.